What is up, butt huggers and feet lovers? Welcome back to Trades and Gains, where we unpack the Federal Reserve policy decisions with more clarity, than the Fed itself. Today, we're going to go ahead and dig into the December rate cut chaos that has been ensuing over the last couple weeks. A month ago, this thing was a slam dunk. Money in the bank. Now, you might as well be betting on the coin toss for the Super Bowl this year. And under the surface, yeah, this isn't about inflation. This isn't about the labor market. This isn't all about control. One word, control. Control over the markets, control over liquidity, control over politics, and control over credibility. And the Fed, for the first time in this cycle, is starting to lose that control. In October, Powell went ahead and cut rates, says inflation is moving in the right direction, and Wall Street cheers. Bond markets tighten. Tech has a nice little rally here. Everyone prepares for a December follow-up like it's a Marvel sequel, except people are actually excited about this. But now, we have Susan Collins, high bar for more easing. Raphael Bostic says, inflation, it's still too high. Neil Kashkari, I didn't even support the October cut. And Mary Daly says it's premature to decide. That's 4 Fed officials publicly expressing hesitation right now. And here's the kicker. This never happens, never happens, unless the Fed is deeply split behind closed doors. Public Fed dissent equals market instability, and markets picked up the signal instantly. Probability of a December cut dropped from 95% all the way down to 49%. The S&P stalled out, the NASDAQ cracked, yields spiked, volatility steepened, and rate-sensitive sectors froze. Think REITs, banks, and utilities. Now, why did this happen? Well, because the Fed just took a perfectly telegraphed move and turned it into a knife fight. Now, let's talk about the elephant in the room. And no, I'm not talking about your mother. Just kidding. But we're going to talk about the shutdown. We had no CPI today. We had no PPI tomorrow. We are going to have no jobs report, no retail sales, no wage data, and no productivity data. The Fed is making a rate decision with half its instruments missing. Ray Charles would have a better chance of reading a book with words and not braille than the Fed making this rate cut decision. The White House admitted some October data may never be released, by the way. Meaning, this December meeting is the least data-driven Fed meeting in 15 years. Our boy Donnie J, Don Trump, is out here setting records that we didn't even know needed to be set, let alone broken in the first place. Now, what happens when you fly a plane without instruments? How about you go ask Boeing and their 737s that literally explode in the sky? But you can go ahead and ask the airline industry as well, because we currently have 5 million stranded passengers and counting. Now, here's the economic reality of where we're at. And this is what the Fed is seeing. So the Fed doesn't have government data, right? But it does have private data. And that's what's spooking hawks right now. Number one, inflation is still above 3%. Torsten Slock from Apollo says 55% of CPI categories are still rising above 3%. Translation, inflation is broad at this point. It is no longer an isolated incident. Number two, the jobs market. It's weakening, but not necessarily collapsing. ADP shows 11,000 job losses per week, but with layoffs, it's still historically low. This sends mixed signals. Not strong enough to justify tightening, not weak enough to justify more cutting. Number three, corporate earnings. They came in surprisingly strong. 82% of the S&P companies beat earnings. Profit margins are starting to stabilize, tech remains dominant, and breadth improving slowly in financials and discretionary. This is why Fed officials say the economy is more resilient than expected. Rate cuts are supposed to support weakness. Hard to argue weakness when markets are hitting record highs, profits are consistently rising, consumer sentiment is rebounding, credit spreads are starting to tighten, and GDP now is still positive. The Fed isn't fighting a recession, it's fighting narrative risk at this point. Now, why is the Fed fighting internally? Powell has one job: keep the market believing that he is in control of this. But in this cycle, well, he's not. Here's the map. So the hawks, these are the people that don't want cuts. No more cuts. They're cut out. They're over the cuts. We have Collins out of Boston. We have Bostic out of Atlanta. We have Schmid out of Kansas City. We have Hammock out of Cleveland. We have Logan out of Dallas. And we have Musalem out of St. Louis. They argue that inflation is still too high. The labor market is actually stable. Cuts risk reaccelerating prices. Tariffs still pushing up costs. And the Fed must protect their credibility. Now the doves, we have Stephen Moran. We have Waller, Bowman, and Jefferson, who's on the cautious side. They argue inflation is still cooling. Shutdown hurt low-income households. Data weakness is only temporary. Financial conditions are way too tight, and housing affordability crisis is getting worse. Now we have the deciders. And no, I'm not talking about the deciders from American Dad, but I'm talking about Powell and Williams. These two need consensus, or markets are going to panic. Powell doesn't want 3 hawkish dissents like October, 3 dovish dissents if he skips, a political nightmare heading into an election cycle, a credibility blow. So Powell's basically boxed in at this point. There's not much he can do, and this is hugely important for the markets. Now, why do the markets care so much, huh? Well, this isn't about 25 basis points anymore. It's about signaling. A December cut tells the markets one thing: the easing cycle will continue. A December skip tells the markets, well, the Fed's pretty much done at this point. So here's what's at stake. 1, liquidity conditions. Rate cuts equal more liquidity. No cuts equal liquidity stalls. Stocks love liquidity, and I hate saying that word. Anyways, last cycle, 70% of markets gains came from liquidity injections. Not earnings, not fundamentals, but liquidity. If Powell pauses early, liquidity dries up. That hits tech, growth, small caps, crypto, AI infrastructure, high duration trades, unprofitable companies, and options flow. Think gamma compression in this case. Treasury markets is the second thing. Bond markets priced in 3 cuts this year already. If December is skipped, the yields will jump, mortgage rates stay high, housing freezes, corporate borrowing costs rise, credit spreads are going to widen, and the T-bill supply chains are going to tighten those purse strings again. This hits risk assets hard. Number 3, the shutdown's aftermath. The shutdown has already disrupted SNAP, delayed paychecks, damaged travel industry, stalled government services, and if the Fed pauses, households will feel the strain even longer. This is political dynamite. Number 4 is positioning risk. Momentum algo funds are long on tech. CTA models are long on equities, and risk parity is long duration. A surprise skip equals forced deleveraging in this case. And number 5, the election cycle. Next year is an election year. If the Fed skips December, cuts begin in January or March or later. This shifts mortgage affordability, credit demand, consumer spending, business capex, market psychology. Washington is watching every move, and Powell absolutely knows it. Now, the real risk: a fragmented Fed. The biggest danger isn't inflation, unemployment, bond yields, or consumer weakness even. The biggest danger is a divided Fed that loses the market's trust. The market needs one narrative. Right now, it has 5 competing ones. That creates higher volume, wider spreads, weaker breadth, trend fragility, policy uncertainty, lower multiples. This is why stocks dipped immediately after Collins' speech. The Fed's unity is breaking, and the market hates when the Fed can't speak with one voice. Now, what is the most likely outcome? The base case, well, we have a 60% chance of this, the hawkish cut. They cut 25 basis points, but signal they're done for now. This will keep liquidity flowing. It minimizes dissent, calms the markets down, and it keeps hawks from revolting, and it keeps doves from panicking. And finally, it sets up January as quote unquote optional. This is going to be Powell's sweet spot. Scenario B, 30% likeliness. Skip December, cut in January. The we need more data play, basically, yeah, this is going to cause short-term volatility, yield spike, stocks to dip, the dollar strengthens, big tech is going to wobble, and the defensives go ahead and outperform. But it resets credibility at least. Scenario C, 10%. Skip and no January cut. Full hawk mode here. Markets, well, absolute carnage. Tech and AI absolutely unwind like an unhinged mom who's had a few too many. Credit tightens, housing stalls, bonds sell off, and this scenario is unlikely, but the risk is absolutely rising for it. Now, why this matters more than any Fed meeting in 2025? Well, again, this is not a meeting about 25 basis point cuts. This is about credibility, market confidence, liquidity cycles, politics, election year positioning, inflation durability, labor market resilience, shutdown fallout, data visibility, global macro alignment, AI hypergrowth funding, corporate borrowing, consumer solvency. You get the picture, right? Because one wrong move in the soft landing all of a sudden becomes a skid mark like a poop stain in your underwear. One right move and the market rips into year end like it's 2020 Tesla all over again. Powell isn't choosing whether to cut rates. He's choosing whether to keep control of the narrative. And right now, well, the narrative is starting to slip. It's starting to slip out. All right. So that's all we got. I hope you guys were able to get something out of this video. I'm your host, Max Pitts. This is Trades and Gains. Make sure you like, subscribe, and comment down below some more suggestions of what you would like to see. And what do you think is going to happen next? Also, we are running a promotion with Investor Central Club right now where we're bringing Black Friday to you early. Use the code BF35 at investorcentralclub.com and get 35% off any plan. We're giving 35% off all plans across the entire site, so make sure you take advantage of that. I hope you all have a great evening, and I will see you for Fast Money Fridays.